The question we have today has been submitted by Gammy, and it is an excellent question because it's never a question that's actually asked on an accounting assessment, but it's really important to understand it when we do all of our assessments. So the question is, why is the balance sheet titled as at and the income statement titled as for the period? And more importantly, what are the accounting principles for doing this? Let's get started. So let's go back and have a really basic analogy. When you're a kid, I don't know whether you did, but in our family, we would always measure how tall we were growing up. So when I was 5, perhaps you might have measured yourself up against the wall. Mum and dad got a ruler out, you draw a line, and then you kept a tally over the years. So let's say when you were 5, you measured yourself and you were 92 centimeters. Then when you were 6, you did it again and you were 104 centimeters. When you were 7, you did it again and you were 111 centimeters, and so on. Well, what you can say is between the ages of 5 and 6, you grew 12 centimeters, and from the age of 6 to 7, you grew 7 centimeters. That's a good way to look at the balance sheet. What we can say is all those measurements on the wall are as at a certain date. So we could say as at the age of 5, you were 92 centimeters tall. As at the age of 6, you were 104 centimeters tall, and so on. Where does the for the period part come in? Well, that's how much you grow. How did you perform? How was your growth? You grew for the period 12 centimeters between 5 and 6. Between the ages of 6 and 7, for that period, you grew 7 centimeters. When we want to think about a business, we just want to sort of get back to basics and go, well, a business owner, when you start your own business, which you'll hopefully do one day, your ultimate goal, whether the business is on the stock exchange, multi-billion-dollar business like Apple or Google, or whether it's a little store that you run out of your home, it doesn't matter. Your number one goal is to increase owner's equity by making profits every year. And a business basically grows or shrinks the same way a person does. But instead of looking at height, we're going to look at owner's equity. So let's say in 2016 we looked at, well, how much was our owner's equity? Let's say it was $2 million. In 2017 we measured it again and we said we found it was $5 million. And in 2018 we measured it again and it was only $1 million. Again, we could look at this by looking at the changes between the years and say between 2016 and 17, owner's equity went up by $3 million. And from 2017 to 2018, owner's equity went down by $4 million. So this is the exact same thing as with our height. We have as at measurements. As at the end of 2016, we had owner's equity of $2 million. As at the end of 2017, owner's equity was $5 million. And as at the end of 2018, it was $1 million. Where do we get the information to update our owner's equity every year? That's our for the period data. So for the period 2016 to 17, owner's equity went up by $3 million. For the period 2017 to 2018, owner's equity went down by $4 million. So between the two of them there, we can see every time we measure something, there's a measure or a mark or a photo or a snapshot as at today's date. And then we compare that to what it was the last time we did it for the period. Putting it in a little bit simpler context, in finance, the story of a business's life is basically told with two reports. We've got as at today, what does something look like today? Now, as a person, we said we measure your height with a mark on the wall. That's an as at measurement. In business, the as at measurement is called a balance sheet. But then we also need to look at, well, how did we grow? How did we perform during the period? And that is where we use what's called an income statement for the period ended. And we have our revenues less our expenses gives us a net profit. Now that net profit makes owner's equity go up or down. Let's take an example and say a business in 2016 had capital or owner's equity of $120,000. Let's say it made a profit of $6,000. Well, that would have made its owner's equity go up to $126,000. In 2017, we started with owner's equity of $126,000. What have we made? A profit of $4,000, and we finished with $130,000. That is basically what our ultimate goal in accounting is to produce this report called the balance sheet and to do this owner's equity section. And we would just keep doing that each and every period. So where we're at now is we've got as at measurements. At the end of each period, capital was $126,000, $130,000, and so on. And it changed for the period with the income statement between each of those measurements. But what accounting theory tells us to do this? It seems a bit abstract and a bit vague at the moment, so let's put it back into some terms that we would have studied. We've got what's called the going concern principle. It says we assume the business will exist forever. It will continue as a going concern for an indefinite or infinite period. We need to balance that out with what's called the reporting period principle. The life of the business is broken into reporting periods of equal length, and at the end of each period, the firm's profit must be determined by matching all revenues earned against expenses incurred. That doesn't really help us much. They're good definitions, but we need to get that back to the question. And when you start a business, we said the number one goal is to increase owner's equity. And what we want to do is we want to start a business today and take owner's equity from a small amount to when we finish with the business, and we want it to be much bigger. We want a big owner's equity figure. Now, that could be we end the business because we retire or we sell it, whatever. But the point is, how do you know how long you're going to own and operate a business for? If you're going to start a business tomorrow, how long are you going to run it for? Well, there's no set or defined period. Everybody's different. We don't know. Some people might run a business for 50 years. Other businesses might last 5 weeks. We don't know. So in accounting, what we do is instead of going, well, and estimating it, yeah, I think it'll be 1 year, 2 years, 3 years, 4 years, 5 years, we just don't know. So what we do instead is, instead of pretending the business will end, we'll just assume it will exist forever. So you can see the infinity symbol there. We're not literally saying it will last forever. It's just an assumption. And the beauty of having that assumption is, well, if we start a business tomorrow with $100,000 of owner's equity, can we just assume that it will last forever and never ever check it again? No. What we want to do is balance that in with the reporting period principle, and we want to check how the business and its owner's equity is going on a regular basis. So we want to check, for example, after 1 year, owner's equity went up from 100,000 to 120. After 2 years, it went up to 190. After 3 years, it went back down to 140. 4 years, it went up to 220, and so on. So what we do to do that is we do regular checks that can be any length of time, but no more than 12 months. You can do 12 reports a year monthly. You could do quarterly reports, half yearly, but you can't have any reporting period longer than 12 months. So let's sort of get this back to basic accounting. We start a business with $100,000 of owner's equity. As at the start of the business, owner's equity is $100,000. A year goes by. For the period ended, we have an income statement. It had revenues of $200,000, less expenses of $180,000 equals net profit of $20,000. So that would mean, as at the end of year one, owner's equity would go up from $100,000 by $20,000 to finish at $120,000. In year two, we started as at a balance of $120,000 of owner's equity. For the period ended, the income statement would show revenues of $300,000 less expenses of $230,000 is a net profit of $70,000. So that would mean, as at the end of year two, our owner's equity will go up to $190,000. And continuing for the third year, for the period ended, income statement shows a profit. In this case, it's actually a loss of $50,000. Expenses are more than revenues. That happens. And as at the end of year three, that would mean owner's equity would go down from $190,000 to $140,000. So what have we learned here? Let's go back to the question. Why is the balance sheet titled as at and the income statement titled as for the period? What are the accounting principles for doing so? It all comes down to the going concern principle. We will assume the business will last forever, but we need to periodically check its financial position as at every so often. We want to look at how is our owner's equity going. We need to balance it out with the reporting period principle. So what we'll do is we'll break this infinite or forever lifetime of the business into periods of equal length. Now, these can't be any longer than 12 months. And what we'll do is we'll check the firm's financial performance for the period by calculating the net profit, and that will change our owner's equity for the end of the period. So we have a nice balance between as at, a snapshot as of today, and for the period, looking at how something changed over a month, 3 months, 6 months, 12 months, whatever your reporting period might be.